Hit it.
Big tech just blew past expectations. The S&P 500 is breaking out. Momentum is building. But here's the real question. Is this the start of a new bull run or just another trap to suck everyone in before it rolls over? Let's take a look at what's really going on. All right. So we got a live stream going on here, and we're going to take questions from all of you. So please make sure you take the moment to type in some questions that you want to have answered. Danny will be joining in a moment to kind of moderate through some of the questions. But I want to focus first on the most relevant things because we were stressing how important corporate earnings were to what the next stage of the cycle is. And here we already had Microsoft and Meta come out today. Google and Tesla were last week. So far, at least these mega cap stocks have been generally beating and bullishly reacting. And that's asking the question, well, what does that mean? Does it mean that there won't be a recession, that there won't be a bear market? Certainly, the stocks started off stronger. And I want to have a quick look at all of these charts. So let's dive into this. So first thing that I want to point out here on the charts is that the S&P 500, when we look at this chart, is trading around this 5,700 level. And Danny, do we got the charts up? I think. One second here. Yeah, all right. Well, I'm not certain of what's going on. I'm going to just wait a second to make sure that the charts get put up here. The All right. One second here. All right. There we go. All right, sorry about that. So S&P 500 is up 60 points on the reaction to these earnings, and so we've got a situation where the markets at this point have had a very solid retracement of the entire decline. So, what is a retracement? I want to take a moment to explain this in detail. A Fibonacci retracement, think of it like a natural bounce in the market. What you have is a sell off in the markets and then a reflexive rally that was known as a bear market rally. These can be measured. The most basic one you can assume is a 50% retracement, which is half of the losses are made back during a very strong rally in the markets. And the fact that majority of the entire bounce happened in one day. Think about this. We got to 5,500 from down in the 4,900 range, almost 600 S&P points in like 3 hours. That means when we're here at 5,650, the market is only 150 points higher than where the market was 3 hours after the market bottom. And so really anybody here anyone here that is watching these markets or trying to go long these markets would have had to have bought the dip 5 days ago in order to be really making any money off of that market low. So we're now in a situation where we have Fibonacci retraced 61.8, right? We are literally at the Fibonacci zone. What is the relevance of this Fibonacci? Why do technicians such as myself care about this? Again, it's because that's a measurement tool for how much a reflexive reactionary secondary move occurs in the market. So you have a primary trend and then you have a reaction. So an example of this is, let's say we go and look here at the S&P 500. This is the 2007 market top. I want to really kind of use a relevant point. So what you saw here was when the bear market started from its October 2007 high during the financial crisis, the first leg down in the bear market was a 19% decline in the markets that happened in about 150 days. Okay. And we saw in about 45 days a 20% decline. So very similar, but happened faster than even during the financial crisis. Now, what I want to highlight, so that was a 295 point or 19% decline. What you want to observe is that the bounce that happened afterward lasted 70 days and was a 12% market rally. But what I want to highlight here, it was 150 S&P points. So think about it. It was a 300 point drop and 150 S&P point rally. Point is that bear market rallies tend to retrace about half of the losses during a rally as they squeeze higher. Now, after that bear market rally was the beginning of the more devastating part of the financial crisis decline, right? And that was kind of the key moment when the market made that transition. So the thing that all of us are asking, the thing that all of you are online here to find out, is this current market rally here? We'll pull it up here on this S&P chart over here. Is this current market bear market rally a bear market rally? Is this going to roll over on the downside? Well, one of the things that was an immediate risk was if we saw a serious deterioration in corporate earnings. This is not manifesting. We still have Apple and Amazon that are going to be coming out very shortly, like in a couple hours. We're going to get their releases. And right now, when we look at this chart on all the Mag 7 stocks, right, we have now are going to see 6 out of the 7 Mag 7 stocks having released. And the 4 that have released have all gapped higher. And I want to put some context onto this in a second, but let's just go through it. First of all, first of all, it started with Tesla, and Tesla on its earnings had this big jump from $260 to $290, approached $300 on the upside. Then came Google. And this is kind of relevant to me because Google gapped higher, but in the next 3-4 days, gave back all of its gains. All right. So it gave back all of its gains. Now we saw today Meta come out, and after a very strong gap higher of 5%, $30, it is already got a red candle. It is already giving some back. The question, will it do what Google did? Is there some money on the sideline that they're going to use the strength from the earnings momentum to sell into? Now, we saw it in Google. I can't guarantee anything, but one of the things to watch over the next week is, will we see a deja vu? Will we see the strength that came from the earnings announcement be given back in the pullback? Now, the other one that's which was a much stronger 8% rally was Microsoft. But what was very relevant about Microsoft, and Microsoft's earnings gap is very different than the other three. Why? Because it was so strong on a relative basis. It basically made it back to its December highs almost in one gapping motion. This makes actually Microsoft's chart more bullish than the others. Now, it's still vulnerable for giving some of those gains back. Could we see Microsoft trade, let's say, back down to 420 or 410 on a short-term basis? Yes. But at this moment, from the 4 that I've reported, I would be more inclined to buy the dip on Microsoft than the other 3. And just because the price action is very different and far more bullish in its nature. Now, that doesn't mean that investors should be going and rushing out buying, because even though these earnings are beating and these Mag 7 stocks are rallying, we are moving towards signals that we are approaching an economic recession. And this is important. So I love to use the poly markets as a recession risk gauge, because when you go and listen to Goldman Sachs or these other economists out there, they all have agendas to talk the company's book and the company's positioning, because they all have clients, they all have issues. So they're always going to give a glass half full when they try to make recession predictions. What I love about poly markets is this people putting real money on the line in betting markets as to recession risk. So therefore, there is no bullshit in there. This is like literally really smart people betting on something like recession risk. Here we're at 62%. We were almost at 70% on the after the ADP numbers came out on the jobs. This is why I believe the jobs number that's coming out on Friday is going to be a key pivot. And this is why we got online together now, because I want all of you to be ready for this. The thing that can happen here is that we could see all of these earnings initially give the stock market a little bit of tailwind, but we are in a highly vulnerable situation with those job numbers. Both JOLTS and the ADP numbers both showed jobs weakness moving toward that way, and there's all sorts of other vulnerabilities. Like I'm just looking here. There was the insured unemployment rates are rising, and what the reason insured unemployment rates are more important, because that's like those ones that are going to get benefits, and it really therefore is a very clean understanding of whether or not companies are laying people off, and that has spiked. And so there's this SOM rule that applies to the rise in unemployment rates, and the all eyes will be on Friday on whether or not these jobs numbers are going to crack this month. And to me, this is the key pivot in deciding whether or not this market is going to roll over here. Now, we do have the FOMC meeting next week. And up till now, the Fed has been far more focused on inflation and taking a very cautious approach to interest rates, which I feel quite strongly is policy error. The Fed has historically done lots of policy errors in the past. This time it's no different. They're staying too tight. How can we tell? Well, every other global central bank, or at least a lot of the other global central banks, the ECB, Bank of Canada, Bank of England, so on, all of these are continue to cut rates. And we have seen global central bank synchronization of rate cutting because they see the global economy weakening. And somehow the Fed is not so worried. And what I think we're going to see is a dovish pivot at some point. Will it be this meeting? I'm not sure yet. But when we do, the market's going to have to bake in more rate cuts from the Fed, and the market is going to suddenly be vulnerable to getting nervous. Well, if the Fed is worried, then we should be worried. This is also very, very important, because past bear markets. Let's just here look at, for instance, the bear market of the great financial crisis, right? Everyone thinks that the Fed being dovish and providing liquidity is bullish, because it means they're flooding the system with money, and that means that the stock markets are likely to rise. But I want to highlight, it was in July of 2007, right here when where I got the circle, where the first rate cut happened by Ben Bernanke. And during the entire bear market, the Fed was cutting interest rates the entire time. So do not assume that if the Fed is taking a dovish pivot, that means it's bullish for the market. It's not. It means that they have to respond because things are breaking, right? And so much news is coming, and it's coming at a time here when we pull up this chart. It's coming at a time when we have made that retracement. So, like the bear market rally that I showed you in 2007 going into 2008, what we saw here was an S&P 500 that declined here on this chart showing 19% from its closing prices, or close to, we'll just round it for this purposes, to 1,200 points. And so what you can observe here, this market rally has been just over 600 points. So we're looking at a scenario where we have now made back roughly half of what was lost. What does this mean? Well, that to me, this means that the asymmetry of this moment is badly skewed in the favor of the bears and against the bulls. And you must be cautious because, fine, Apple and even like we could have a scenario where Apple and Amazon beat, and maybe the market is even up another 50 S&P points tomorrow. I'm not in any way trying to say the short-term day-by-day price action can't have that reaction function. But as a whole, if I was to just go back onto this chart here, what I want to highlight is that there is probably here a limited upside, maybe 5,800 on the S&P. So we have maybe 150 S&P points to the upside. Now cross that with another bear market decline leg. And I want to highlight that during bear markets, rarely is the second leg shorter than the first. Often the second leg down in a bear market is of equal length or longer. So this decline over here was almost a 1,200 point decline. That means that if we had just an equal length decline of 1,200 points, we're talking 4,500 on the S&P. So you're talking over 1,000 S&P points downside risk, right? And 150 S&P points upside potential. Now, I don't know what kind of trading universe you come from, but for me and all my members, when you have potential $100 to make and you're going to risk losing 1,000 when you're wrong, this is a bad risk reward. This is a dangerous time. This is I view rather that short-term rallies in this market should be viewed as an opportunity to lighten up on things that you are losing on, and or turning around and basically it's going to be a scenario where the downside risk is where the real damage can come. And know many of you remember what April felt like in that first week. It's a really ugly scenario when the market sells. Now, listen, everyone, this is a live scenario. I want to make sure we answer questions if you have any. So feel free to type it in. I'm going to just cover a couple more things. If there's any questions, we'll answer them. And otherwise, we'll give it a wrap for this session. What I want, the next thing that I want to highlight here is why or what will drive a potential next leg down in this market. And I want to leave all of you with this. The first leg down in this market was the reaction function to Trump and his tweets and the tariff scares and everything like this. It is a very big mistake. I'll repeat this. It's a very big mistake for all of you to assume that Trump's tweets and the tariff headlines will drive the next leg down. They won't. Now, it doesn't mean that Trump's tweet or a deal or some other thing won't cause 100 to 150 S&P point move. It will. It will create volatility in the market. But the next leg down in this market is 100% coming if it does happen at all. So first of all, I can't guarantee there's going to be another leg. My thesis is that this is a bear market rally. We are going lower. But so what I'm saying though, if I'm right and this market does go lower, then what will drive that next drop? And so for me, that next drop is going to be driven by all market participants realizing that a recession is actually a reality. And more importantly, that this will impact corporate earnings and it will impact the multiples people are going to pay for those earnings. This is the conditions that almost always are there for there to be a 30+% decline in the markets. And so the idea that a Trump tweet is going to take us down to being down 30% on the year, doubt it. I'm a seller on this. It will be a genuine fundamental repricing of the stock market based upon that. And so then the question many of you are going to ask is, well, can you protect yourself from this? Well, number one, what you can do is, first of all, make sure you're not margined, right? So those of you that are margined or leveraged in some way, the risk of margin call is really nasty during these declines, and you shouldn't be leveraged. Now, if you do want to maintain investments or you're in investments that generally are long term in their nature, you can theoretically hold them through, but there are options for you to turn around and buy insurance or protection. It is a very interesting time to do this. The VIX, the volatility index, here I'll just put it up on the chart, is back to 24. Now, we have seen it prior to the bear market trade down in the teens, but if I'm right about this being a bear market, volatility shouldn't go much lower than 20. And so you are now in the kind of few percentage points towards a support line at 20 that is going to be the bottom of volatility. What does that mean? What does it mean when I say that? It means that volatility premium is how much the option ultimately costs you. And so you don't want to overpay for buying portfolio insurance. You want, because then you risk that once the in portfolio insurance gets repriced, you're going to be losing money on it, and it's going to be harder for it to be doing protection for you because of the risk of those declines, right? And so this, though, in my mind, is a very interesting time to be putting on portfolio insurance because volatility has come off. And that's what we're doing real time at Big Picture Trading. The links are in the message boards underneath below. So anyone wants to try a free trial and see what we're doing, check it out. All right. So I think we're going to let's go to questions. Danny, jump on here, buddy. Is there any questions or anything we should cover?
Yeah, there's a couple. We've got some people actually asking about what option structured trades could you use to profit off the S&P sell-off? That's from Paul in Dubai.
Okay, well, I think that the one strategy we like to utilize the most in this environment is debit spreads, but we put debit spreads differently than others because we are flexible about opening and widening and narrowing the spreads when we have different market biases. So a lot of people, when they open up a spread, they have only a fixed return in there. We're much more fluid on using them. This allows us to have a much smaller capital outlay, but still be able to capture much of the same gains during market declines. Any other ones, Danny?
Yep. So from Mitch, He's asking, how does the dollar perform in the down leg? Do you think it's possible for the dollar to go make a new high, or what do you think?
This is a tricky one. Now, if you go back to intermarket relationships, books written about this stuff over the last 30, 40 years, typically the US dollar is a safe haven. And when sell-offs happen, there is usually a demand and a rush for US dollars. This has been the case in many of the past bear markets, and many are asking if that's going to happen again. There's one catch this time. This time we have a bipolar world and a trade war going on. And so the world is in a situation where buying more US dollars has some pushback here. Some pushback, and a lot of other countries are seeking to diversify their U.S. holdings. Now, that doesn't make me super bearish the dollar, but I do also at the same time kind of I give a far less probability that the U.S. dollar has a huge upside rip. I think that the dollar has much greater risk of just churning in a trade range where the Dixie might go back to 105 or 106 and then trade back down to under 100 and just kind of muddle through this scenario and not see a rip to an all-time high. All right, Danny, any last ones?
We've got one person asking about gold. What does it do in the second leg? That's pretty much the last one, I would say.
Listen, we talked about in the previous YouTube video 3,200 level. Guess where we're trading? 25 points off of the 3,200 level. To me, this is the kind of fulcrum point of whether or not gold is going to get bought on dip here. To me, this is an asymmetric trade. This is an asymmetric trade to buy the dip here on gold, long as you follow our rules and stop yourself out if that level doesn't hold. This is not, we're only looking this as a tactical buy on dip on the short term to discover whether this is the turn point. If 100 doesn't hold, we're going to be in a gold correction that lasts into the summer, maybe through May and June, and we'll probably see 3,000 on the downside. And that was what you'd have to expect if 3,200 doesn't hold. But my initial position is trying to buy the dip at 3,200 here. Let's see if it ends up holding. By the way, if any of you want to follow me on doing this, we're doing this real time with our big picture trading members. I'm online every single day with them, with showing live trades and putting on stuff. So check it out with the free trial if you guys are interested. All right. Danny, I think we should, is that a wrap, buddy? Or do you say a last one you want to squeeze in?
No, I think we can wrap there. Yep.
All right. Listen, that's we'll wrap things up. Thanks everyone for joining me. We'll try to do these live streams even once or twice a week going forward. So thanks everyone for joining us, and we'll catch you on the next ones in the future.